Thanks for organizer for putting together such a nice conference. It's a great pleasure to be part of it. And thank you, audience, for attending. So my name is Kiril Shacknov. I'm from University of Surrey, and this is a joint work from with Luana Zakaria, who is at in our Institute in Rome. So let me start with this motivating figure. As many of you probably familiar, there was a rise and then consequential fall of ICOs. So during this figure plot the aggregate volume of ICO funding over the last 4 years. So the market was definitely hot at the end of 2017 and beginning of 2018. And the total amount of funds raised on ICO was very comparable to early stage VC round worldwide. And then sequentially this we observed this rapid decline, and by the beginning of 2020, the ICO market was almost dead. So this brings us to the question, will there be ICO comeback? And if yes, in what form? And to answer this question, we provide the entrepreneurial finance perspective. In particular, we ask two very related questions. What are the specific contributions of cryptocurrency market to entrepreneurial finance? Are they useful? Are they add value, relax financial constraint? And the second question, if they do, and we believe that they provide some useful benefits, then what prevent the worldwide or more widely adoption of the token-based finance or crypto finance? So, particular advantage of ICO, which has been recognized by the literature, is the fact that it's allow you to explore network externality at the early stage. And this has happened because of dual role of token holders. On one hand, the investors, the source of funds for young startups. On the other hand, they is source of the future customer base. And on the contrary, venture capitalists don't provide such advantage because because of their nature. It's a small number of institutional investors. On the same time, venture capitalists provide other very useful value-adding services. And in particular, they provide strategic advising, monitoring, human resource management, establishment relationships with potential customers and suppliers. And there is a vast literature, both theoretical and empirical, that documents these additional value-added services of venture capitalists. And again, ICO investors, being dispersed and not involved in the management of the company, don't provide such benefits for the firm. So in the sense, there is a natural complementarity between ICOs and venture capital financing arise. And young startup, even young ICO startup, increasingly recognize the importance of venture capitalist funding. And let me give you this quote, that companies that raise large ICOs have publicly expressed interest in holding new investment round to bring in professional venture capitalists. And the reason why, because money alone won't open the doors, but often connection can. So basically, given that there is this natural complementarity, so any firm potentially should optimally choose to have a mix of ICOs and VC. And the question is, the main question which we after in this paper, what prevents the firm from exploiting this complementarity benefit? Why not all firms decided to go for ICO funding? And to answer this question, we write down a simple theory of stage financing. And it's well known that typically financing for young startup delivered in stages. And the reason why, because staging create extra value and allow investors and entrepreneurs reevaluate the investment strategy and learn about the future opportunities. So, and our hypothesis in this paper that the lack of transparency of cryptocurrency markets prevent information revelation and lead to adverse selection. And consequently, despite of the natural complementarity, the information friction discourage use of cryptocurrency and lead to suboptimal funding choices. So, in order to formalize this argument, we proceed in following steps. There are three building block assumptions, and each of them leads to the three set of testable implications. So at the beginning, we build a theory, and then we test our prediction of our theory based on the data. So what is the assumptions? The assumptions I more or less already explained you. So on one hand, ICO finding allow to exploit the network externality. So it's by helping to expand the customer base. On the other hand, venture capitalists, by providing the value-added services, boost productivity. So, however, due to informational friction, there is a trade-off. If the firm decided to go for ICO on the early stage, it faces a cost of adverse selection in the later stage when apply for VC funding, because the VC cannot differentiate between highly productive and low productive firms. And consequently, we sort of have a lemon market problem. Then there is this, so we assume this natural complementarity between externality effect and VC value-added services. So this set of three assumptions generate three set of the testable results. In particular, the second one about selection. So there is a selection along externality dimension. So only project with high externality use crypto finance. And because of the complementarity, so only firms which apply for ICO has an effect of the externality on the final outcomes or firm value. And finally, because of the adverse selection, so the adverse selection cost increase with network externality. Now, here's the timing. So the finding, there are two finding rounds and two phases. So there is one experiment we call experimentation phase, and at the beginning, at period T0, young startup has no funds and decided how much to borrow from and from what source to borrow. So it can go either for VC or ICO, and decided how much needs to raise. Capital K. In the second round of investment, it can further decide whether to go for VC or not obtain second round of funding. And finally, at the time T2, the firm value realized. And the firm value is the product of the firm productivity and the number of customers. So let me unpack the firm value. Let me start with the second component. So at the beginning, at the first round of investment, the funds which obtain are spent on the boosting their customer base. But depending on the funding method in the first round, if it's VC, we normalize the number of customers to 1. And in case of ICO, we assume that number of customers is mu greater than 1. So basically, the ICO gives you this extra boost of the boosting initial customer base relative to VC. Then the final customer base is the product of initial customer base times the investment, and on top of it, how initial customer base turn into the final customer base depends on the externality effect epsilon. So the larger is the epsilon, the larger is the final customer base. Notice that because by assumption, the externality only play a role when there is a ICO finding in the first round. So only ICO finding allow to exploit the externality effect. Now, the second component related to the firm productivity. So we assume that it's a combination of two. exogenous entrepreneurial ability. So basically, like all firms in our setup are different in terms of two dimensions, in terms of entrepreneurial ability and the network externality. So network externality I discussed in the previous slide. Now let's dig into the second source of heterogeneity. So we assume for simplicity that entrepreneurial ability can be either high or low, and high ability realized with probability P. Then now informational structure, which is crucial. So we assume that ability is initially unknown to anyone at the time T0, but in the before second fund investment round, it's revealed to the firm insiders. Who are the firm insiders? Firm insiders are always entrepreneurs, and it could be also VC investors if they participate in the first funding round. Then, if in the second funding round, if firm decided to go for second funding round, it further raise some amount of capital kappa, which is spent on the boosting productivity. So, without second stage VC finance, there is no extra additional boost of productivity. Okay, so the rest of parameters are common knowledge, and they're known to everyone at time T0. So the only parameter which is unknown is the entrepreneurial ability, but it's revealed to the firm insiders in the intermediate stage before second round of investment. So what are the entrepreneurial choices? Entrepreneurial choices, they decided how much capital to raise in the first round, what is the source of funding in the first round, and whether to do or not to do the follow-up round. So, as usual, we solve this model by backwards, starting from the entrepreneurial optimal choice in the second round, conditional on the funding choice in the first round. So it's the same timeline which was presented a few slides ago, but apart from the investment rounds and the firm value, I add here extra information, in particular that this omega, which is the entrepreneurial ability, revealed to the firm insiders at the time T1 before second investment round. So consequentially, the second investment round can be conditioned on the omega. Then in the final investment round, so at the end of commercialization phase, the firm value is realized. And depending on what was the sequence of the funding rounds before, we have four possibilities. If firm did ICO initially and no funding in the second round, then there is the extra boost in terms of customer base, so and depending on epsilon, but there is no boost in terms of productivity. And if it did ICO VC, then there is a boost both in terms of customer base and productivity. And in case of VC only, there is no boost at all. And when we see VC, we boost productivity due to second round of investment. So consequently, from here, you can see that if omega would be observable to everyone, then the optimal choice for all firms is to go for ICO and VC. So why it doesn't happen? So here we calculate explicitly the entrepreneurial expected payoff at time 0, depending on the funding round in the first stage. So as you see, if entrepreneur decided to go for ICO, then it get a boost in terms of customer base, but due to selection equilibrium, only get productivity boost in case of it turned to be low ability entrepreneur, and no productivity boost in terms of when it's turned to be high ability entrepreneur. Instead, when it's decided to go for VC, it's continue for VC in the second round, and in this case, because the omega is revealed to the firm insiders, so we have no boost in terms of externality, but there is no negative selection equilibrium in terms of productivity. Consequently, if you take a difference between the two, this difference becomes a function of epsilon or externality. So also note that entrepreneurial expected payoff is net present value of the firm. So the value of the firm minus all investments, which is done, investment in the first round and investment in the second round. So this function is an increasing function of epsilon. And it's when epsilon is 0, then this difference is negative, and when epsilon is infinity, then this difference is positive. So then there is one unique value at which entrepreneurs are indifferent between going for ICO and VC. And this is determined as value of epsilon star. So entrepreneurs with externality larger than epsilon star decided to go for ICO in the first round, and the entrepreneurs with low externality decided to go for VC in the first round. So this is the same structure, but graphically. At the time 0, everyone observe a level of externality, and if it's low externality, if firm turn to be low externality, then it goes for VC funding in the first round, and omega reveal to the both VC and entrepreneurs, and it's continue to get VC funding independently of whether it's high or low ability. So instead, if it goes for ICO in the first round, the omega reveal only to entrepreneurs. And consequently, we have a selection equilibrium when higher ability entrepreneurs are better off not obtaining VC funding in the second round, and only low ability entrepreneurs go for VC funding in the second stage. Okay, so the selection over epsilon doesn't arise from the optimal matching choices, but due to informational friction in the later stage. So ICO funding dominates VC funding in the first round in the absence of the adverse selection. So if in the benchmark case, when there is no private information, when everything is public common knowledge, then all firms would go for ICO funding in the first round. However, due to this adverse selection, some firms, low externality firms, decided not to go for ICO funding. Okay, so now the prediction of the model which we're going to bring to the data. The first one is this selection along externality dimension. So the firms which go for ICO, they tend to be high externality firms. And low externality firms tend to go for VC funding only. Then the effect of externality on the firm value is the positive. So the firm value is increasing with externality for the ICO funded firms, and externality has no impact on firm value for VC only funded firms. And furthermore, then there is this complementarity. So the effect of externality on firm value is stronger for ICO VC funding versus ICO only. Okay, what is the data? We look at the funding events of blockchain-based companies founded after 2015 on the Crunchbase. Crunchbase is the relatively common source of the data for VC funding rounds. And we have 1,200 firms and roughly 2,300 funding rounds. And the outcomes which we look at is web traffic. So the issue is these young startups, they have no income statement or balance sheet. And given that they all sort of internet-based, the web traffic to their web page seems to be as the best proxy which we can think of in terms of outcomes. Now, this is a distribution of funding rounds. As you see, roughly 25% of the funding rounds are ICOs. Now, how we measure network externality? We measure network externality by constructing network externality index, which count keywords in the short business description of the firm. And the keywords which we think tend to signal the importance of the network externality are communities, exchange, peer, network, marketplace, auction, portals, gaming, and so on. Now, if we compare the Crunchbase deals to the more common data set in ICO literature, which is ICO bench, we see that, so the issue is that in ICO bench data, there is only ICO firms which go for ICO. So there is no counterpart. The firms, similar firms, which decided to go only for VC funding round. So consequentially, this data set is not suited to study our question. But we still want to know how representative the Crunchbase deals are, because ICO bench tend to be covered sort of universe of ICOs. So, and what we uncovered that the deals which documented in Crunchbase tend to be larger. So the average amount of funds raised 3 times higher, 12 million versus 4 million. They tend to close faster. But what's interesting that they similar along dimension which me most interested. In particular, our proxy for the externality. So we construct externality index for all firms in ICO bench and in Crunchbase, and they're very similar, tend to be very similar. And furthermore, they're very similar in terms of rating from ICO bench. So the ICO bench rank ICOs and put a rating for the, and also in terms of media presence. So sort of proxy for productivity. Okay, now the first result, this selection along the externality dimension. So the dependent variable is a dummy variable, which take 1 if a firm obtain funding through ICO. And as you see, externality increase probability. So the higher is the externality, the higher is the probability the firm goes for ICO. So which confirms our first results. Also interesting, we control for many other characteristics, but particular one, which has very strong impact if it's location of the firm. So firms which located in North America tend to go less, they're less likely to go for ICO. And for this can be 2 explanations. First of all, so there are 2 potential channels. One is more widely available VC funding in North America, but also the regulation. So the regulation in the US was not particularly crypto friendly. Okay, now the second set of results. In this column, so in the first column, we document the probability of follow-up round conditional on ICO being a first round. And as consistent with our model prediction, due to this negative selection equilibrium, firm which goes to ICO, only low ability firms then go for follow-up fundings. And we have this negative coefficient. Then in terms of the outcomes, which is we measure by web traffic. So web traffic is our proxy for firm value. We see that if firms go for ICO only, then there is no effect of externality interaction term on the web traffic. But if firms go for ICO, then there is a positive, strong positive effect. And then we can further split this interaction term between ICO and VC fundings times externality and ICO only funding. And we see that effect is stronger. So the complementarity is stronger between ICO and VC funding. So all our theoretical predictions seems to be supported by the data. Now, let me conclude. In this paper, we propose a model of stage financing where entrepreneurs can choose between ICO and VC funding, and ICO allows young startup to explore network externality at the early stage, while VC boost firm value through additional value-added services such as monitoring and strategic advices. Then there is a natural complementarity between these 2 sources of finance. However, opacity of cryptocurrency market limit use of the mixed funding and lead to suboptimal funding choices. And we provide empirical evidence which is consistent with this theory. In particular, the firms that use ICO funds are characterized by relatively high level of network externality relatively to the firms which optimally choose to obtain only VC funding. And the output depends on the funding method, not only depends on the whether it, so basically the mixed strategy, which is the optimal one, amplify the externality effect. Thank you. If you have questions, I would be happy to answer them.
Okay, thank you, Kiril. I don't see any questions on the Q&A. So it looks like we're over time by a few minutes. So in the interest of time, I think it might be best to move on. Thank you very much for contribution, Kiril. This was very interesting to see.
Thank you for including the paper in the program.
Yes, please do. And thank you for this. And when you say that the opacity in, can I ask one question?
Yeah.
The opacity in cryptocurrency markets. When you say the opacity in cryptocurrency markets can limit the use of mixed funding, what do you mean exactly? Are you indicating that we should that we need some of the VC funding to demonstrate that this is real? How do you interpret this?
So, I mean, like there is kind of standard idea about what is that financial market reveal information. And why they reveal information? Because, I don't know, there are firm insiders. So, fruit. But here, because investors are really know very little about young startups. So they have kind of, so there is no any like income or balance sheet statement, and there is no way to sort of reveal information about these firms.
Right. So it sounds like what you're saying is the VC can actually can provide additional validation to these firms. Is that right?
Yes, sort of. I mean, they are on top of it. They kind of provide a different source of useful services which boost firm value. But they furthermore because they clearly, if you firm insider, you have more information about the firm than some investor which located far away and basically, and there is no any reporting on these firms.
Okay, and we have a question in the chat just very briefly from Gilbert Lopez. Can cross-border regulation involving automation and AML KYC help to limit this obscurity in the use of crypto? Is that possible?
So, but who we validate? We validate, I guess, entrepreneurs. So I'm trying to understand. So basically, the KYC, like we apply to, I guess, for firm founders, no?
Yeah, I think that what Gilbert is mentioning is describing is the. I think that what he is describing is the investors because of the use of ICOs to source cross-border funding.
So the idea that like if there is a big institutional investors participating in ICO and it's reveal his identity, then it's a useful signal. But yeah, potentially.